Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a smarter investor, period. All right, let's get a minute on that shot clock. And stock of the day is Tesla. I think it's been my last four stocks of the day for the podcast with good reason. This one is actually tied to Trump's 100-day mark, which will be on April 29th. Now, coming into the Trump presidency, you would think Tesla would have done well, stock would have been on fire. That hasn't been the case. Through the first 100 days of the Trump presidency, shares of Tesla look poised to be down more than 30%, despite Elon Musk having that close proximity to the president. Of course, Tesla's first quarter results, pressure in terms of sales, pressure in terms of profits, outlook now good. I know Musk is coming back, but still stock down more than 30%. And what really caught my attention here and why I'm making Tesla the stock of the day today, new AP poll on Musk, it found just 33% of U.S. adults have a favorable view of Musk. That's down from 41% in December. 2/3 of those polled say they have just given Musk too much influence in government. Put that together, you really start to understand why Tesla sales have come under pressure. All right, enough with Tesla here. I know you hear me talk about it all the time. Let's bring in our featured guest for today, former Bridgewater CIO Rebecca Patterson. Rebecca, always nice to see you.
Great to see you,
too.
It's
been a while. I know you're right back from the IMF meetings in D.C. What was what are those meetings like, first of all, for you? And then what are some of the things you found on the ground this year?
Sure. So the International Monetary Fund and World Bank gather twice a year every year, April and October, and basically it's speed dating for macro people like me. You have policymakers from all over the world who come together for meetings, and then there's lots of other meetings on the sidelines. And so you can really get a quick read on almost every economy in the world within 4 days. So it's very, very efficient, and you get a lot of good takeaways. And there's other investors and researchers there like me, so you also can share notes with them and see how they're thinking about things. So that's what it is. In terms of my takeaway, the biggest one to me was a read on the non-US investor, the global investor right now, and I'm talking about large institutional investors, people who run large pension funds, sovereign wealth funds, et cetera, and they're rethinking the United States. To me, that was a big, big deal.
I thought stocks have rallied back. Mm-hmm. So that surprises me a bit to hear.
A little bit. Since we got the pause on Liberation Day, the 90-day pause, and then we also had President Trump pulling back a little bit from his attacks on the Federal Reserve, which, thank goodness, I think both of those things have given a bit of a sense of hope that there is a Trump put, that if things get bad, the president and the administration will back off because they don't want to see their policies cause a U.S. recession or a bear market. I think that's leading to some buying, and the idea that we might get all these deals in 90 days is leading to some buying. But I don't think we're through the worst of it. That's probably my big point here, that if you are an equity investor, or especially a bond investor with yields coming back down on the 10-year in the last few days, this is an opportunity to lighten up a little bit. In my opinion, I don't think you need to do it today, but in the coming weeks or so, because we are going to see the tariffs bite. Just this week, on May 2nd, this thing called the de minimis tariff. That's on the little tiny parcels, the $800 or less parcels that come through the border, all that stuff my teenage daughter will buy on Amazon.com, and I think, why do you need this? What is it even? Those things, the prices are going to go up, in some cases, 120, 130%. Starting next week. Now, there's some inventory pulled forward, so it might not come all on day one, but we're going to see that rolling out. The 10% tariff still in place. Big Chinese tariffs. There's a lot that isn't going away, regardless of what happens with any deal making. That's going to be a tax on the consumer. So I think that's going to pressure us. But kind of circling back to the IMF, the thing there that I'm worried about is, and it's not just the trade war, it's the worries about U.S. institutions like the Federal Reserve. It's worries about the U.S. as a reliable partner on things like NATO, on things like Greenland, Panama, Canada as a 51st state. Even if it was said in jest, it's not being taken that way. It's being taken seriously. And so we're seeing a lot of global investors saying, what else could happen? Could there be a tax on capital flows?
So the international community, investment community, they don't trust the U.S.?
look, I don't want to generalize and say the entire world no longer trusts U.S. That would be an overstatement. But I think there is a new risk premium on U.S. assets as seen by foreign investors that did not exist before the Liberation Day, maybe before the administration started. And what that means is that, and I'm just using data from the Treasury here, the most recent one is from late last year. So the Treasury Department estimates we have about $30 trillion of U.S. equity and bond holdings by foreign investors. So let's say I am the investment committee of a big pension fund in Canada. We meet once a quarter. We're having our next meeting. We're saying, gosh, we've been overweight the U.S. for the last few years.
So more bullish on the U.S.
Right. And now we're going to trim that position maybe by 2 percentage points, incremental. Let's just take a little off the table. Let's do the same with bonds. If you reduce allocations to U.S. stocks and bonds by 4% total, it's tiny. And that happened generally around foreign investors, $1.2 trillion would leave U.S. assets.
Where does it go?
I think it goes back to home countries. It goes to other foreign markets. I think we're already seeing that some of it's going to things like gold. So it's going to get dispersed around the world into different asset classes. I'm more worried about what it means in the U.S. for the bond market than the stock market, because whatever Congress tells us they're doing on the budget, we know that we're going to see more issuance of bonds as we are getting less revenue versus our spending. We're going to have relatively less demand from foreign investors, so bond yields are going higher. I don't know if we have a so-called Liz Truss moment like 2022 in the United Kingdom when UK bond yields spiked, but I think we are going to see U.S. Treasury yields, especially at the longer end, settling at a slightly higher level.
Are you talking 5% on the 10-year?
I hope not. If we saw 5% or higher, I think psychologically that could be pretty damaging for other asset classes, stocks, credit, et cetera.
It was damaging.
Well, we
rose
touched
from
it.
4% to what, 5?
We touched 5% briefly on the 30-year, and the U.S. 10-year has gotten close a couple times now. So if we saw the 10-year rising slowly, gradually, it's not as big of a deal, but it's still doing damage. It's raising your mortgage rate. It's raising your auto loan cost. It's making it more expensive for companies to borrow to grow. All of that acts like a limit on GDP growth and, frankly, a limit on stock valuations. So this isn't a crisis. This isn't immediate. This is kind of that slow hurricane approaching the coast. You don't know if it's going to hit you directly or on the side, but you know it's going to do damage. You know it's coming. That's what I think we're going to see probably over the next few months. It's a slow bleed, but it's meaningful, and investors shouldn't be overlooking it.
So we haven't seen the worst for stocks then?
I don't think so. Look, my hope is that we get enough deals that the rest of the tariffs are disregarded. You know, we kind of say, okay, we got what we needed. We don't need to do this anymore. I don't know how likely that is. And you know, now the fact that the bullish argument is, oh, we're going to reduce Chinese tariffs to only 60%.
But they're still there, and there was no 60% 2 months ago.
Exactly, Brian. Right. So, you know, January 1st, people thought 60% was crazy. Now we're saying, oh, well, this is
new normal,
this is
Rebecca.
Great news. This is a major tax on the consumer, and we can't forget that. And we're starting to see it in some of the data. We're certainly seeing it from corporations as they talk about their outlooks. I think it's going to feed more and more to the quote unquote hard data, retail sales, payrolls in the coming months. Again, it's not immediate, it's not a crisis, but it's going to unfold this summer. And that's why I think if you got this bounce in stocks, you say thank you very much, and maybe you start taking a little off the table, or you move into slightly more defensive sectors like staples.
Why isn't it a crisis? Let me give you an example. And it's, you know, we were talking off camera about Metamucil.
Yeah.
So I talked to a lot of CEOs.
Yeah, you brought it up.
I brought it up. I talked to the CEO of Procter & Gamble, John Moeller, and he said there's an ingredient Metamucil plant that is just grown in India. And I asked him, why can't you move it from India to the U.S.? Don't have the climate for it. So this one plant is going to be, I guess, tariffed where it wasn't before. Prices are going to go up for Metamucil. I mean, but there's more instances of that.
Yeah.
It's going to go up for soda. We heard that from PepsiCo. I've talked to Whirlpool CEO, Mark Bitzer. Appliance prices are going up. This sounds like a potential crisis on our hands.
Well, companies, as we know, are doing everything they can to limit the damage. There was a good piece, I think, I'm not going to say the paper because I can't remember for sure which it was, about companies this morning that are doing everything they can to control costs without layoffs for now. If we cross that Rubicon and it's no longer just trim costs where you can, but gosh, we need to start laying off workers, it can quickly snowball crisis, recession, whatever you want to call it, right? We'll be going down that road. I don't think we'll see that this Friday in the payroll report. I think we'll see some moderation in job creation, but not as a cliff fall yet. We're not seeing that from companies yet. But if these things keep building, we're going to hit that tipping point. Again, I think it's probably a few months away, but it's coming. Could it be a crisis? It could, sure. I mean, look, I think April 2nd to April 8th was a mini crisis. If that had continued, that would have quickly turned into a financial crisis. Now, the Federal Reserve can step in. They can do financial stability measures like they did around Silicon Valley Bank or the UK did when they had their crisis in 2022. But that's one-off. That's not going to prevent the economy from slowing and possibly having a recession. So they're limited what they can do. And our fiscal space is more limited now. With a budget deficit around 7% of GDP, when growth has been 3% in the last year or so, what are they going to do when the stuff hits the fan? They don't have a lot of room.
I think we're about to find out. Hang with us, Rebecca. We're going to go off for a quick break. We'll be right back. All right, welcome back to Opening Bid. Having a fun chat here at the NASDAQ in Times Square with former Bridgewater CIO Rebecca Patterson. You're focused on the Fed, and you're right to do so. How important was it that the president, for now, has backed off on his attacks on Jerome Powell?
I think it's incredibly important that he backed off, because if you start questioning the Fed's independence, it's going to push up inflation expectations. That's going to push up bond yields, put more term premium in the bond yield, which makes borrowing costs higher, which acts as a weight on growth. So I think it's incredibly important he backed off. I don't know if we're out of the woods. We have a Fed meeting coming up in about a week, and the Fed will probably do nothing because there's no reason to act.
And then come the attacks again.
Exactly. That's my point.
Yes.
So then we're going to get more verbal attacks. The Powell's term ends next May. It seems pretty likely that President Trump would like someone else in the seat, and that's going to be important too. Who is in the seat? Is it someone who is going to be independent? Is it going to be someone who is trying to say what Trump wants to hear, which we hear from certain members of his cabinet? So I don't think we're out of the woods on that yet, though, although I do think it's a big positive, or at least removing a negative, that he has backed off on this idea that we're looking at firing him, which is what Kevin Hassett reportedly said.
Why wouldn't it be the Treasury Secretary potential? He's been
taking
floated,
the seat?
Taking the seat.
Possible. And certainly the markets view him, I believe, as more of an adult in the room, so to speak, than some of the other cabinet members. Certainly he has been more reflective and more reassuring to investors, especially over the last week or so at the IMF meetings.
Yeah, when we talked to him just before the IMF meetings, I'm sitting right across from him. Rebecca, I didn't get the sense that there's any deal anytime close on China. And I was just sitting there, I'm like, wow, okay. And then I see markets rallying, and I don't get it. I don't get it.
Well, one thing that I've been thinking about a lot is, to your point, given everything going on, given this incredible level of uncertainty, why would anyone be buying the dip? I do think it's important to remember that, especially since the pandemic, we have seen a resurgence of the retail investor in the United States. And I don't know the exact breakdown politically between Democrat and Republican among those investors, but I think it's probably fair to say at least half are Republican. And that retail investor, I think, has been more of a dip buyer, so to speak, much more short-term, trading on headlines, and that is a pretty big subcomponent behind the market these days. So, when we get proper data and we can parse this in the coming weeks and months, it wouldn't surprise me if one of the main supports we're seeing from for the market right now is coming from more Trump-friendly retail/speculative short-term traders
that still believe in what the administration is doing.
Correct, and believe that we're going to get to the other side, right? So they think this president is maybe a little chaotic on process, but he's getting to the right goal. It's worked for them before, so hold on for dear life sort of mentality.
But institutions are
are going the other way.
They're going the other way.
Absolutely. We are seeing institutions going the other way.
Are they? I imagine they're concerned about the fundamentals of companies.
Yeah, absolutely. And again, that retail investor, if I'm right now this is a hypothesis, it's not proven. If I'm right that the retail investor is the main support right now behind the recent rally, they can keep playing that game until they start losing their jobs and or the stagflationary effects of the tariffs start to affect their purchasing power, in which case they have to start pulling back too. And again, I think it's coming. It's a question of exact timing and degree, but it's coming, and I would say probably in the next month or two.
Using all your decades of experience, whether it's Bridgewater or even before then.
My wisdom.
Yes, your wisdom and analyzing companies and talking to institutions. What would you tell the retail investor that is out there buying the dip? You know, the Yahoo Finance is the home of the retail investor. Every morning, millions of people wake up. They come to us. They have our portfolios on their platform. They're watching videos. They're doing everything on this amazing portal. What do you tell this group that seems still very confident?
That's a great question. You know, there's nothing wrong with day trading. A lot of people do it for a living and make very good income from it. But if this is money that you're counting on to be your retirement income, your long-term savings, you don't want to try to time something that's not timeable. President Trump's posts are not timeable. How these deals play out or not is not timeable. So you're basically just gambling. And that is not how you save for the long term. If you're doing this short term because it's fun, it's entertainment, and you can afford to lose a certain amount of money if things don't go your way, God bless, have a great time. But if this is longer term oriented money, then I would make sure that a good chunk of it is in something that you're just sitting on, that you're not trying to go up and down and tactically trade. That might be money markets, short-term bonds right now, which are still getting you over 4%. It might be a small allocation to gold, which I remain bullish on as central banks continue to diversify. If you want to stay in the equity markets, maybe you move a little bit more into defensive industries like consumer staples. If you want global diversification, maybe you look for markets that are a little less volatile than the S&P, that are more cheaply valued. Things like the UK right now, I would put in that bucket. It tends to be a more defensive equity market, and it does look like the UK Prime Minister is having some good progress making deals with President Trump. Emerging markets, the one that jumps out to me today, again, this one I would be small on, especially if I'm taking a longer term view. But when I look at who wins from the trade war, no one wins, first of all. But relative winners, one of the countries that's caught my eye is Brazil. They're getting market share from the United States on things like agriculture. They're getting market share from places like China on things like textiles and shoes.
Maybe they can grow that Metamucil plant.
Maybe, right?
Yeah.
That's a great point. I know a lot of older people in Florida who'd be very happy to hear that.
We're gonna take that off. We'll take it offline. Why, in the last minute, we always love to get a hot take from our guests. So my question to you is this: why gold?
So gold tends to perform best at the tails, either a recession/crisis or an overheating economy where inflation might become unanchored. Right now, we're in the left tail. There is a possible recession/crisis, and that tends to lead retail investors, just normal investors, into gold. However, at the same time, and what we've seen over the last few years, is central banks getting a little more anxious about their exposures to the United States, trying to diversify. They're looking around the world and saying, I need something safe and liquid, and gold helps fill that bucket. And so we've seen record buying from central banks, not just for the last year, but for the last 3 years in a row now. China's a big piece of it, but it's certainly not alone. There's a number of central banks. I think that, especially with what we've lived through these 100 days of Trump, is likely to continue.
I imagine it's going to be an interesting next 100 days.
Yes.
Rebecca Patterson, always nice to see you. Thank you so much for joining Opening Bid. This was a real treat as always.
My pleasure. Thanks.
All right, and that's it for the latest episode of Opening Bid. As always, continue to hit us with those amazing ratings on all the podcast platforms and on YouTube. Hit us with those thumbs up. I love all your comments. I read them all. Keep them coming, because that's how we continue to make this thing better. We'll talk to you soon.